All right, about 15 minutes to the closing bell. We want to keep an eye on what's happening with these markets. And you can see here that the Dow, the S&P 500, and the NASDAQ are in negative territory. The Dow now off about 12 points, the S&P 500 falling about 14 points, and the NASDAQ is off by 128 points. Sometimes investors pay very close attention to what we hear from the Federal Reserve, and the next FOMC meeting will begin on June 15th. Brian Cheung covers the Federal Reserve, and he joins us now because he has a special guest. Brian?
Thanks, Adam. Well, joining us here on a Yahoo Finance exclusive interview is New York Fed President John Williams. Thank you so much for joining us here on the platform this afternoon. Obviously, I want to kick things off with the economic data. A lot of eyes on the jobs report covering the month of May that'll be released tomorrow. The street's expecting 5.9% unemployment. Non-farm payroll estimates are bouncing somewhere in the 674,000 range. Now, I just want to ask you, what do you expect to see, or maybe rather, what would you like to see in that jobs print tomorrow morning?
Well, Brian, it's great to be here with you today. First of all, what I would like to see is, strong job growth. I'm very focused on achieving maximum employment. It's going to take more than 1 month to get there, of course, but I definitely would like to see a strong labor report in terms of job growth, continued progress on the economic recovery, and trying to get the country's economy back to full strength.
Now, we were speaking with Rich Clarida, the vice chairman of the Fed last week, and he was saying that at the pace of job gains right now, obviously given the kind of less than stellar report that we got for the month of April, it might not be until August of 2022 until we recoup the 8 million or so jobs that were lost compared to pre-pandemic levels. From your view, what you're seeing in the New York area or in the country at large, why is that pace not faster? Are there certain things that are holding back people going back to their jobs?
Well, this is an extraordinary situation we're in. The economy is reopening, supported by strong fiscal support and progress on vaccinations. I don't think this is a typical recession or a typical recovery. So it's really hard to predict exactly the speed at which this happens. Clearly, the recent data show demand is strong. And the supply side of the economy needs to catch up and grow at the same speed. So I think we'll have to see how that plays out over the coming months. But my view is overall we got very strong demand going forward for the rest of the year into next year. I expect the economy will adapt to the rapid recovery, and we're going to see very good jobs growth. I expect to see really strong GDP growth this year. And see good growth next year. So I think it's, the overall picture is very positive. I think the timing of all this and how quickly, people can be matched with the jobs and businesses can reopen and all that can happen. We'll have to wait and see on that, but I'm pretty optimistic that that's going to happen. It just may take some time to get all that to come together.
Now, I want to expand on the sometime bit as it relates to quantitative easing in a second, but I do want to just kind of stay on this labor market theme because you walk down Broadway here in New York. I'm in Brooklyn. There's a lot of kind of postings that you see on these businesses saying we're looking for workers, we can't find workers, and obviously that is what we're hearing anecdotally across the country. But there's many kind of reasons for why people aren't going back to work, whether or not it's childcare or unemployment insurance. In your vantage point, what is the main kind of structural reason for why employers simply can't fill these jobs?
Well, I wouldn't call it structural reasons. I think these are really just adjustments of the economy opening up really quickly because of the progress on vaccinations, obviously supported by fiscal policy, that people are able to come back into the economy and spend money. And that's really great. It's just going to take some time, as it always does, for the businesses and others to adjust to that. Put out the vacancies. We know that job vacancies are really high levels. It takes some time to interview people, get people on board. And as you pointed out, there are still people clearly worried about the health aspects of the pandemic. We're not completely through that, and other issues that you mentioned. I do think, again, this is a process that's going to take several months, to work itself out. But, the strong labor demand, people, want to get back to work, and they will. It's just, it's just going to, I think, again, take a matter of a month or several months to see that progress. I do believe that, businesses and, the American economy is remarkably dynamic. Businesses will figure out ways to move that process along quicker, get people onboarded more quickly. Obviously, I think wages will adjust with a strong economic rebound, and we're also seeing huge numbers of new small businesses being created in the spirit of entrepreneurship out there. So all these dynamic factors, they don't happen overnight, but they are in play, and I think will help accelerate the economy getting back to full strength.
All right, President Williams, you did use the word progress, and we know that the guiding light for the Federal Reserve with regards to quantitative easing is that it'll start to taper that $120 billion a month pace of asset purchases once it sees substantial further progress. Now, some of your colleagues in Philadelphia, in Dallas, among others, have already said now might be the time to start thinking about tapering those asset purchases. Do you think it's time to start thinking about tapering those purchases?
Well, we set that, marker of substantial further progress, back at the end of last year. And, obviously the economy has improved. I think it's on a good trajectory, but to my mind, we're still quite a ways off from reaching the substantial further progress that, we're really looking for in terms of adjustments to our purchases of our asset purchase program. That said, we have to be thinking ahead, planning ahead. And so I do think it makes sense for us to be thinking through the various options that we may have in the future, talking about, how the economy is doing, where we see it going, and understanding how that's, may play out over coming months, and really be thinking about those going forward. Right now, my view is, we're not near the substantial further progress marker, but of course we always need to be analyzing where we are in the economy, where is that relative to our maximum employment and price stability goals, and really how do we get monetary policy positioned well to achieve those goals over coming years.
Okay, so you're not going to bring up that conversation in 2 weeks?
Bring up the
tapering conversation.
No, I think that we should be thinking through all of the issues around the economic recovery, and thinking about policy options in the future. I just don't think the time is now to take any actions on it.
Well, and some of that, I guess, might just be your approach or your views on inflation. There's a very rigorous debate right now about whether or not the current policy setting is going to allow inflation to maybe run away if the economy overheats. Now, just broadly, we did get a PCE print last week, core PCE, when you strip out those more volatile components, about 3.1% year over year. We've heard your talking points about inflation being transitory, but what might you be looking for to see if some of those trends might be a little bit more secular and maybe less transitory or temporary?
Well, as you know, price stability, low and stable inflation averaging 2% is one of our two key goals, along with maximum employment. So I take this very seriously in watching the data carefully, analyzing what's happening. This is again an extraordinary period of time as the economy opens up rapidly, and we're seeing demand, especially for certain things. People are willing to travel again, and stay at hotels and get on planes, and buy used cars, apparently, because that market is very hot. So we're definitely seeing that dynamic play out, and certain prices rise pretty quickly, while other parts of the economy we haven't seen those kind of increases. We also have to keep in mind that some of the increases we're seeing are really just reversals of price declines that happened a little over a year ago when the pandemic really took hold. So it's really about, I think, analyzing the data carefully, understanding what represents maybe the unique aspects of the reopening of the economy and not expected to persist into next year and the year after that, and what aspects indicate maybe more kind of persistent or sustained inflationary dynamics. So it's really about carefully reading the data, analyzing it, and I would just say not overreacting to every single data point, but making sure you're bringing all the information together. My personal view is that a big chunk of the increase in the inflation measures that we've seen is really partly this reversal of price declines from before, what we often call base effects, plus some special factors like used cars and others, where clearly the pandemic has affected demand for certain goods that are in short supply, at least in the near term. I go back to this dynamic economy, though. I mean, this is an economy that has worked on very, limited inventories and very tight supply chains in the past. And with the pandemic, that's made it a little bit hard to adjust to the rapid reopening. So, of course, we're seeing some supply chain issues, some shortages of supplies and things. But again, I see those as being worked out over coming months and quarters as businesses adjust to the more rapidly growing economy. Last thing I'll say on inflation is, even before the pandemic and, for many years, I do follow other inflation measures like the trim mean inflation rate. They're, produced by my colleagues in Dallas and Cleveland. And so, those measures are designed to try to get the underlying inflation rate, at least so far. I think that they've been showing, moderate increases in prices, more consistent or near our 2% goal. So again, looking at all the information and really be attuned to looking for signs that we're seeing a more persistent, sustained inflation, which of course we would, we don't want inflation to be too much above our 2% goal. We really want to have this average 2% over time.